So 80% of the mangroves in Burma have been destroyed. And Burma has a lot of area that is flood prone, right? So mangroves are just amazing miracles. They grow in salt water, right? Under ideal conditions, they can actually sequester up to 1 ton of CO2, permanently in the ground, while providing flood protection and all those other benefits that, there's more fish that people catch. So Arne's idea is essentially that he can plant 1 mangrove seedling for about $1, right? And that we can structure an investment in which this is actually then registered in an Ethereum registry, the Regis registry, so you could buy a certain number of trees and you would have the carbon rights to that tree. So the economic benefit of this 1 tree, 1 ton formula, that's under idealized circumstances. The realistic figure might be that we could only produce maybe 1/3 of that, but the economics still make sense. So, but I'll work with the simple numbers, right? So the value of that $1 investment that sequesters 1 ton of carbon is that global harm is reduced by $220, roughly. That's the social cost of carbon, according to Stanford. And then projects like this have co-benefits on average of $664 per ton, right? So you can see that $1 investment, in this case, it'll take 20 years to generate that ton, will have, close to $900 of benefits, right, in an idealized circumstance. Even if it's 1/3 of that, $1 goes to 300, still pretty good. So the question is how can investors, right? The world wins, right? It takes carbon out. The local community wins. It provides flood protection and increases fishery catch, and you can do other things like have bees there and so on. But how does an investor make money from that is the question, right? And in this particular case, what's nice is that there is a carbon market, right? And there's an institutional carbon market where about 12% of the carbon dioxide that is produced in the world by humans, there's a market for that already. The size of that market is $50 billion or something like that. So that's the regulated market. But there's another market that's interesting. It's the voluntary carbon market, where 0.3% of companies have decided voluntarily that, we will assess our carbon footprint and we will buy carbon credits and offset them. And what's interesting is if you look at who the 0.3% is, then you'll get it. It's all the leading firms, right? It is, Google, it is Microsoft, it's Goldman Sachs, it's Adidas, it's Puma, and so on. So if that 0.3% goes to 3%, we can see that this will be something quite extraordinary. And the amazing thing is that 0.3% will go to 3% at some point in time. There's never been a case of a company saying, we've decided to be carbon neutral, and then the next year say, actually that was a terrible waste of money. We're just going to go and pollute again. So it's an amazing thing because these companies simply look at the map. They're like, we could spend our corporate social responsibility dollar in terms of, making advertisements like ExxonMobil does, for example, about how wonderful they are, and then have, journalists actually criticize every single one of these things to say that actually you don't do these things. Or we could actually walk the walk, right, and support projects like Arne's, support another project that we're working on in Borneo, which is a wonderful project by the person who first came up with the accounting methodology that allows private capital to save forests, right? So it's an amazing market, and that market could expand quite dramatically, right? So if you look at if you look at the world as a risk manager, right? What I've learned is focus on exponentials and think in terms of scenarios, right? So what we do have is we've got an exponentially growing awareness that our ecosystem matters, and at the same time we're racing exponential escalation in climate change. And the second thing is looking at it in terms of scenarios. I talked to one former hedge fund manager who managed the money for Soros. He did the investments in mining companies, right? I thought this would be perfect for him, like to look at carbon credits as a as insurance to his very carbon-intensive industry. But he had the typical way of thinking of many people, which is, carbon markets, people have talked about that, for a long time. They've collapsed and there'll never be a carbon price, right? To which my response is, maybe you're right, but maybe you're not. And there's a whole range of scenarios, right? So you have to think about, there's the chance that we don't do anything, that there's a chance that we have a low price for carbon, a moderate price for carbon, or a high price for carbon. And each of those has a probability. And then if you actually look at what those prices are, right, then it gets actually very interesting. The lowest social cost of carbon estimate of any government is the United States estimate of $38 per ton. ExxonMobil has a planning price of $80 per ton, right now. Sweden has implemented a price of about 111, and actually Switzerland has a national carbon credit system where on average in Switzerland, the voluntary carbon market, actually no, this might be the regulated carbon market, apparently the average price was up to 160 Swiss francs. And then you have Stanford's social cost of carbon at 220, and then you have risk managers like Bob Litterman, former head of risk at Goldman Sachs Asset Management, saying, it's a very simple picture here. We have a derailed train, he shows a picture of a derailed train, and saying that train went around a corner too fast. So the optimal response if you're a risk manager, if you're driving a car and you realize you're going too fast, around a corner, you don't just very gently touch the brake, you have to actually hit the brake pretty hard, right? And then you can let go, right? So essentially what he's recommending is that the optimal strategy for carbon pricing that most people think about is this curve that goes upwards. So the really bad scenarios happen in 50 years, 40 years, 30 years, and then you discount them, right? He proposes that that's actually, using this discount rate is actually quite foolish, and that the optimal risk response is the shape of the curve should look the opposite. It should be backwardated. You put a really high price first, and then you lower the price. So that would be scenarios up to $300 to $400 to $450 per ton. And interestingly, at the seminar, this was the ERM symposium in Chicago 2 years ago, where Bob Litterman spoke, and I spoke there as well. I spoke to someone from ConocoPhillips on what he thought was the most interesting scenario. He thought price on carbon $450 per ton, and that's, by the way, it's not that big of a deal. It sounds like it's a lot, but that every $100 adds $1 per gallon of gasoline, right? So these numbers this wouldn't be economic collapse. Right? This would mean a few firms would pay quite a bit. So roughly what we're talking about overall that needs to go in natural capital, right, is actually, it's an amazing thing. The numbers that we're talking about that we need to systematically, how we need to reinvent money, if we can reinvent money where 1% goes into natural capital, we're sustainable, right? So that's another amazing thing that I discovered in this journey, that there's such a disconnect between how big the problem is that we're facing with, for example, climate change, and the general knowledge around the big drivers of climate change, right? And I'll give you guys a quick quiz question right now to see who can guess what is the single biggest source of carbon emissions in the world. And if you don't, that's interesting. And if you don't know it, don't feel bad, because I've basically out of 10 people that I've asked, none have gotten it. And it took a professor who just wrote a book about the price of carbon 5 tries to get the right thing. So it's not cows, but interestingly, cows, has come. It's a very popular answer. People really think that that's significant. Yeah. So of course, there's methane, which is a very potent gas, right? But methane actually breaks down much faster than carbon dioxide in the atmosphere, right? So it's not cows. And any other guesses?
Technology production units.
Sorry,
technology production units.
No, not technology.
Is ocean? CO2 is?
So the biggest source of emissions, right? What's the, so typically what people will say, like global coal power or airlines,
Humans.
like that. Sorry?
Humans itself?
Humans as a whole category is quite general,
Yes,
so I would say
they all do this.
let's narrow it down to what human activity, what thing that humans do that actually.
I would think by destroying nature, we are releasing carbon from the ground.
You got it. Deforestation is the single biggest source of carbon emissions. So just two countries alone, Indonesia and Brazil, account for 20% of the world's carbon emissions from their deforestation, right? And so this is an amazing opportunity, right? Where if you stop deforestation, it will be the equivalent of taking all the cars off the road for 10 years. It's that big. And so an amazing study was done by an economist. This was Lord Stern, Lord Nicholas Stern, who wrote the 2006 Stern Report. And it made that simple statement that climate change is severe. We're risking scenarios which could result in a 5% decline in global GDP per annum, some of the worst case tail scenarios. But for about 1% of GDP, we could mitigate some of the worst tail effects. And then he said, probably the best return on investment globally to fight climate change would be to simply pay developing countries not to cut down their forests, right? Yes?
Sorry, I think it's not actually CO2 generation that is done by deforestation. It's not enabling the environment to absorb the CO2 from the...
It's both, yeah. So, for example, Indonesia, in 2 months of last year, if you look at the Google map of what part of the forest burned, like the whole country, in 2 months, the release of carbon dioxide from the burning forests exceeded the entire economic output of every single human being, except for 2 economies in the world. That's in 2 months, right? So these are very peat-rich forests, right? They have like a lot of organic matter that goes up. So you release a lot, and then you're right. You've destroyed a system that actually is very good at sequestering carbon. Right?
So that's the fire of the...
These are purposely, this fire is done, these are not accidents, right? So for example, Malaysia's largest palm oil company was just caught draining peatland, which normally, of an area that they promised to protect. And then, the second thing that happened is, there's an accidental fire, right? So accidentally there's a draining of this land, and then accidentally there's a fire, right? And then accidentally there's, but we can put palm oil there, right? So there's a very small, essentially a number of people and organizations that are causing inordinate harm. But the good news is this, right? That this mechanism, essentially this idea that we can stop deforestation by essentially helping capital buy the carbon credits from that. This is a really promising opportunity to actually turn ecology into economy. So the first person to propose protecting forests for carbon credits was Todd Lemons, who developed this methodology and proposed it for Kyoto's cap and trade, right? And it was rejected by the UN initially because they hate private capital, they hate messing with their thing, and they tried to claim that you could not accurately quantify the carbon content of a forest, right? And he proved them wrong. He said you can, and now it's part of the UN Red Plus program. So he not only developed this methodology, but then he protected an area about the size of Singapore that only exists because of his action. So it took him about 5 years. He started with 100,000 hectares, and palm oil was encroaching on all sides, cutting down the forest, even though they were not allowed to, until he was left with 65,000, right? So essentially that forest only exists because of him. There's, hundreds of species of birds and mammals, including dozens of endangered mammals, including orangutans. And it's a wonderful project. And I will now show you the basic details of how this particular investment, I believe, will be an investment that will probably be one of the best performing securities in your portfolio, apart from Lykke shares, right? So here are the economics. So one issue with carbon markets is that there's no credit rating agency, right? And that means that basically prices range from 10 cents per ton to $40 per ton. This is just forestry credits. The stuff that's selling for 10 cents or anything much lower than $2, these are probably projects that are possibly more harmful than good. So some of the projects have planted the wrong trees. Some have planted the right trees but didn't work with the community, which cut down the trees. Some projects have had fraud, human rights abuses, all kinds of things in them, right? But the majority of the projects which have certified carbon credits, though, are quite worthy projects, right? So these are things where hundreds of thousands of dollars are spent in audit fees, right? So this is independently audited. So the way you should think about this is that it's kind of like wine. Imagine like this: that there's a winemaker, right? And that by purchasing a particular wine, right? That by purchasing, say, a Robert Mondavi wine, you're protecting, in a way, the vines that grow in the Robert Mondavi vineyard. And so the idea is, out of all of these different carbon credits, which range in this wide price range from 10 cents to $40, we found a project which, let's say that it has the perfect Robert Parker score, right? There are, out of thousands of projects, there are 4 projects with a triple gold rating in terms of community and climate and biodiversity, right? It's a wonderful project. So we've pretty much found the best, one of the best projects in the world to support. Now, if you go to Todd and basically say, I'd like to support your project, I'd like to buy some of your wine, right? Buy some of your carbon credits, he would say, happy to help you. Our minimum ticket size is 10,000 tons, right? And the price for that is $10, okay? And then the way you would then collect this, so this works really very much like the wine market, the carbon markets. There are 2 types of players in the carbon markets. There are those that consume the wine, right? And those that collect or invest in the wine, right? So the ones that consume the wine would be like Microsoft. Every year it assesses its carbon footprint. It might be 500,000 tons. And then they buy 500,000 tons of carbon credits to then consume or retire, right? The second kind are basically...
May I interrupt you?
Sure.
Do I understand this correct? It's kind of like, you mentioned the table, it's kind of like it is burned down forest, and now the investor will build up the forest, and the best investor has now a share, like a small plot of forest, and then, for example, the Microsoft comes and says, which is then the consumer, I need to have a carbon certificate, and I, as the investor who has grown basically this forest again, sell basically my share to the consumer.
Yes, essentially it's done like that, except that there's a UN program, right, that qualifies certain areas, and so your area would pretty much need to be in the many tens of thousands of hectares, right? In terms of regrowing forests, that makes sense if the forest has been destroyed. To protect an existing ecosystem, it has to be under threat from destruction, right? So it has to be filed for agricultural conversion, and then it's registered with typically the Voluntary carbon standard, right? Which then takes an auditor in there, and the auditor assesses the carbon footprint of that forest. So in Todd's case, by keeping that forest alive, he's created 119 million tons of carbon dioxide in 30 years, right? So that's the perfect scenario. But if he doesn't manage his forest well, if he burns down part of the forest, he gets less credit for that, right? So every year there's an audit with satellite imagery, right? Any kind of black spots, they actually subtract the species. And then there's what's called a VCU, a verified carbon unit, which is like the bottles of wine. That this auditor will then say, okay, out of the 119 million, you're supposed to invest 4.1 million per year if you keep this forest healthy. But in this particular case, you lost some trees, and there was slower regrowth in another area, so you only have 3.8. Those 3.8 million tons are all registered individually by serial number, so they can't be double sold, right? So it's like literally as a wine investor, you would buy 22 bottles of wine, and that's, you know, those 22 units, 22 carbon credits, each have their own serial number, and then you would store that at the market registry or at the Apex registry, right? So that's kind of how the mechanics work of the whole thing. Now, just kind of let me show you really quickly the economics of this deal and why I think you find this really interesting. So Todd's average sale price is $6 per ton, right? So $10 is his 10,000 ton, but if you agree to buy 100,000 tons, you'll get a price of $6, so you spend $600,000. But even if you're going to do that, right, what you have to do then is you have to find another buyer, right? You can register these credits, and it's still difficult because a lot of the buying is actually done by intermediaries. So 50% of the trading in voluntary carbon markets is done by South Pole Group. South Pole Group buys at 3, sells at 9. Those kinds of spreads. They take a very big spread because the end buyers essentially are afraid to make a choice, right? Because there's no credit rating, there's no bond that says this is a AAA rated bond. They don't want to make the wrong decision, right? So that's the $6 price point. The $5 price point is where essentially Zurich Insurance agreed to buy 5 years, guaranteed 150,000 tons per year, right? So Zurich Insurance is paying Todd guaranteed $750,000 for the next 5 years, right? The price that Todd gave us, because he wants to put carbon markets on the map as the best performing asset class in the world, is he's going to give us his, essentially the lowest price that he can authorize himself without having to get approval from his Indonesian partner, which is $2.65 per ton, right? So what we're going to do, the first rainforest bond, we'll structure in a really nice way, where not only are we going to lock in this low price per ton, we're going to prepay for future years, okay? So the idea is that we do a rainforest bond, and this is the same thing that Allianz did for Todd in 2012 when he launched his project. It was Allianz that said, wonderful project, we will prepay for full 30 years of carbon credits. And Todd, and then what Allianz negotiated with Todd is that the future payments would be discounted by 10% per annum, right? So essentially Todd will give us the same thing, so that we have an instrument that will yield an expected return of 20% per year for the first 5 years, if we do 5 years. And then beyond that, it'll be a 10% return, right? And that 10% return will be, in form of carbon credits, right? So this is the structure that actually helped Todd survive declining carbon markets, because he was able to put $6 million into the bank, right, by pre-selling. Carbon markets back then were at about $10 or 7 to 8 euros, and they have since collapsed to about $3.30 to an all-time low, right? Does anyone know why carbon markets have collapsed, by the way? This is another good quiz question. Any idea?
Because probably the number of projects generating carbon credits are going higher and higher.
There's supply. There's definitely supply. The other dynamic. This is an interesting case study of a market failure. Actually, most people don't actually know how this process works, but essentially what happened was that carbon markets were launched at the peak of the economic bubble, right? And instead of listening to economists who said, listen, just charge a price for carbon for anyone, the policymakers tried to make the carbon markets more appealable by introducing a cap and trade program. So the way that would work is that you would assign a free carbon credit to say utilities, so that you don't make it so difficult. So you might say RWE in Germany, big coal-fired power plant. We don't want to be too hard on you. You get 500,000 free, pollution credits, and if you need more than 500,000, then you have to buy them in the market, right? So they assign these caps, assuming strong economic growth at very generous levels. Then Lehman happened, economic growth collapsed. Everyone had more caps than they needed, so they gave out these free caps. There was no need for carbon credits. They collapsed to like nothing. You just, basically they gave the awards too generously. So that was the main driver, that actually carbon pricing is the right way to go about it, but the way it was implemented was totally, was truly amateurish.
Those caps for example include the quotas.
Exactly, they're like quotas, exactly. So they way overassigned the quotas, assuming, big economic growth, right?
But the quotas are somehow actually related to the whole, the world quota, right?
Sure. So that basically countries have agreed, under, I guess, before in Kyoto, certain countries signed up to agree to hold those, stay within certain limits, and then they gave out those limits to various industries and so on. But this is overall just a very clumsy way of going about it, because the right way to incentivize is not to sort of say, well, you can pollute for free until here. It's just like, well, just pay for the pollution, right? There's no need to subsidize pollution, right? But of course, it's easier to sell this way, right? So by the way, global carbon, we know, I mentioned this social cost of carbon, right? That carbon has a cost that it causes some damage in the world, right? That social cost, let's say, is $220. But what's interesting is actually the actual carbon price. There's actually, the world on average incentivizes the burning of fossil fuels by $14 per ton of carbon. So not only is the price not zero, countries in developing countries are actually subsidizing oil prices to make it cheaper to burn, or like the Japanese, giving away coal-fired power plant. So it's not even just like we're doing the opposite. Instead of penalizing, we're actually giving a benefit to, go ahead and burn some, build a new coal-fired power plant, we'll give you the financing, buy another car, gas-guzzling car because gasoline is cheap. So that's a really important realization of market failure. And that takes me to one project that I think we should do an award for, which is it's this amazing kind of thing where there's such a disconnect between how big the problem is and how low the general knowledge is. And it kind of reminds me of risk metrics in the early days, right? When you had to basically, JP Morgan and Goldman Sachs and Bankers Trust, it all had these kind of models, but everyone had different assumptions. And then Till Guilderman, one of your countrymen here from Switzerland, he was head of research at JP Morgan, and said, let's just publish risk metrics, a free open benchmark, so everyone can talk apples to apples, right? And then they hired Peter Zingari, straight from school, fresh econometrics PhD, and then a couple other people worked on that as well. I went by the MSc office in New York 2 weeks ago, and I thanked him, saying it gave many of us great careers in risk management, and suggested, how about the next step now, carbon risk metrics or climate risk metrics? And what he said was, Alan, this is actually really interesting. I have to say, I know very little about it. You'll have to tell me how to educate myself. And by the way, Bob Linderman was my boss at Goldman Sachs Asset Management, right? So this is amazing how a tiny investment, essentially the Riskmetrics tech doc, the investment for JP Morgan was Peter Zagiari working, say, full-time for a year. It was John Matero working part-time for a few months talking about, technology infrastructure, someone else working on the data issue, Jacques Longerstay writing an introduction part-time for a couple of weeks basically, Tilda Wilderman writing a little thing. It was basically like, but the real manpower was there, it was one person, working full-time, who then, by the way, by standardizing everything, came up with a methodology that was better than what JP Morgan used internally, right? So JP Morgan changed, so it's like one guy. But these are, it's interesting, and it strikes me that it's a very similar opportunity in the climate risk space. Over 3 decades, this is not a new thing, right? 3 decades, there's been a lot of research done. But it's kind of at this point where, there's a lot of the looking at sandcorns in the microscope kind of thing, right? That's what kind of woke me up to this whole thing, where this UBS banker said that, we were looking at sandcorns in the microscope when the tsunami hit, right? So the point is, sometimes we have to zoom out and see what are the big picture things. And I think what we need here, what can really help, is if we have a common language, right, for communicating about climate risk, common data to plug into all the analytics. And the last project that Ethan Berman and Greg Berman, not related, but Ethan was the CEO of Riskmetrics and Greg ran the market risk group, the last project that they wanted to spearhead before leaving was called Prometheus, a really wonderful idea where Riskmetrics thought, we should just open source everything. All of our analytics, all of our pricing models, just open source it, right? The shareholders kind of thought that was crazy, right? But there was actually logic in that because what drove the Riskmetrics model was that, Deutsche Bank has to crunch through 90,000 portfolios on a daily basis, and it's the service that we provide to Deutsche Bank, not the fact that, they can look at what pricing model or risk model was used. And then the other idea that was so brilliant here is that they wanted to just open things up to anyone to put in models, right? Because we're constantly building models. And so this idea that I spoke with someone yesterday, just this last week in London, who kind of reminded me of this Prometheus, connected to climate change. Imagine this, you have one portal, right, where you just focus on the data, right? You just assemble, you get, and a lot of the data is all there, but you basically have, you create an architecture where anyone can plop in their climate risk models, right, into this architecture. That can then become a platform where you can first of all see the big picture things, right? Again, it's amazing that someone who spent years writing a book about carbon pricing, where it's a wonderful initiative, right? By the way, so Richard Clark has developed this model where he looks at weather volatility and the impact on insurance losses, and he can have a real-time update depending on the location for what the theoretical price for carbon would be. But he didn't know what the biggest contributor to carbon was, number one, right? The other thing that was really interesting, I said, okay, looking at your number right now, you have spot price for carbon in London should be 13.1. I was like, so that's very precise, right? So how does that compare against, say, Stanford's 220 or the U.S. government's $38? He said, oh, I can do all of those. I can, if you put in any kind of non-linearities, any kind of other things, you easily get to $400, $500, $600, right? Depending on if you use the 3% discounting rate or a lower discounting rate, you get vastly different numbers, right? So that also reminded me that we need to be able to talk apples to apples, right? That there's so many different modeling assumptions that a tiny little change, right, can change the number from 13 to 38 to 220 to 400, right? Just tiny little tweaks, right? So I think this is, like as an aside, a really interesting opportunity if we can create a Lykke Climate Prize, right? Work with institutions that have done a lot of work on this. So I was up at Cambridge speaking to them about that. They've done a lot of work on insurance losses around climate change. What was interesting there, as well was that for them, actually, they couldn't get industry interested in paying for this research because industry is interested in scenarios that play out in 3 to 5 years, maximum 10. Anything that's above the 10-year, no one's going to fund that, right? So that's interesting. So how do you actually get people interested? So then I met with a lawyer from Client Earth. They're funded by really big hedge funds like the Children's Investment Fund, and they work with the Grantham Research Institute. They have 70 lawyers that all they do is they sue governments, they sue corporations for climate change. And there we crack the code. It's like, there's how we can get to scenarios that are interesting. There's where we can get to a Lehman moment, right? Where, for example, you take a firm like ExxonMobil that for 30 years, not only knew climate change was real from their own research, but acted on it to protect their own interests. They storm-proofed their platforms and prepared for rising sea levels, while not only covering this up and not telling anyone, but actually funding research that basically cast doubt on climate change, right? That's a massive lawsuit waiting to happen, right? So these are some of the scenarios that I think could be really interesting, where you look at kind of once we have a common language to communicate about natural capital and what impacts natural capital, then we can basically start to talk apples to apples, see what different models are telling us, and then put in different kinds of scenarios and see how they connect, right? Including legal and regulatory scenarios. Right? So that's one thing. But let me just finish up here by finishing the overall challenge that I think would be worthy to do, where the Xprize, right? The Xprize is this challenge that Peter Diamandis has to spark exponential changes for kind of new industries to start. One was for spaceflight, right? So I think that Elon Musk's SpaceX won a 10 million prize. The 10 million prize money, though, that resulted in, say, a dozen different firms investing $10 million each to make it to that prize, and you learn from each of these contributors, right? There's a new Xprize that they have, which is a carbon Xprize. So anyone who comes up with an engineering solution to do something useful out of carbon dioxide, this waste product that we have, can win $20 million, right? So if you guys are engineers and have good ideas, my point to Peter Diamandis is this, right? That engineering challenge is only one thing, right? And actually we've solved a lot of the big problems that we need in terms of engineering. But the carbon problem, right? The carbon problem is not only an engineering problem, and in fact, it's primarily an economic problem, right? The reason we have climate change, right? The root cause of this ecological crisis is an economic crisis. We have simply, by design, underpriced carbon, right? And that's a solvable problem, right? So how about this? An award for anyone who can design a financial product that does the following. One, it reduces the risk of climate change, right? Number two, it has to make money for investors, right? And number three, even if, this investment was a wonderful thing, it reduced the risk of climate change, but still we get some worst case scenarios, say in 10 years, there's an insurance-like payoff in the future, right? Because then insurance companies are interested in this.